Namaste, my dear students, and good afternoon to all of you. Happy to have you back in the class. This is the third session we have, and I hope you have gone through the lessons in the previous classes that were taught in the previous classes, and you're okay with it. If you're not okay, please send your queries. I'll be happy to answer your queries. All the queries that have come, they are not very complex, and I think you are understanding the lesson. If not, please feel free to ask. I hope you are all well and safe, and let us start the class now. Okay, feel comfortable, all of you. And I start by answering previous days' queries, which some few queries are not answered. Only 6 or 7 of them. One person has asked, what is elasticity of demand? You know, it is responsiveness or how your demand reacts to a change in one of the variables. It can be price, it can be income, it can be the price of related good. So that how you respond, how much you respond, whether you respond only little or whether you respond more. And we try to measure it and put it in one number, which is a coefficient, and that is elasticity. I hope it is clear. Then, what is the meaning of exception to the law of demand? This is what one student has asked. Exception means law of demand does not apply or hold good in these cases. For example, if I say diamond, higher the price, higher the demand. What is the law of demand? Higher the price, lower should be the demand. So the law of demand does not hold good in the case of exceptions. Okay? Then another question that is asked is, in price elasticity of demand, is it necessary to put the negative sign? It is not necessary, because if you put the negative sign, our interpretation will become exactly opposite. So ignore the negative sign for price elasticity, but don't ignore it for income elasticity and cross elasticity. Then arc elasticity and point elasticity, many students have asked that doubt. So I have drawn on the board. See, this is an arc. See, it forms an arc on the curve. When does it happen? When the price changes are so substantial. See, this much price change, it forms an arc on the demand curve. And we measure the elasticity on this arc. We say it is arc elasticity of demand. Okay? Then, if you measure elasticity at a particular point on the demand curve, we say it is point elasticity of demand. I hope it is clear. Arc is on a specified portion and point is on a point on the demand curve. Then, next question that was asked is, if nothing is mentioned, which method to use? They will not mention which method to use in the elasticity. What they say is, they'll give you the question. Then, if you have worked out questions, you will know which method to use from the very wording of the question. Sometimes percentages will be directly given. Sometimes price may be given in percentage and quantity may be given in numbers. Sometimes both price and quantity will be given and no percentages will be given. In that case, you have to apply the formula given in 2.39 page. I hope your book is with you. That is our Q1 minus Q2. Divided by Q1 plus Q2 formula. Okay, that midpoint method, right? Definitely there is problem when elasticity comes because different examiners use different formula. So you have to be a little careful because you have to come for the answer and try doing it in 1 or 2 different ways in case you are not getting answer. Suppose somebody puts it not in midpoint method, especially for income elasticity and all, it's a problem, and you have to go for another method. Okay, and so you have to be a little careful when elasticity is calculated. Then another question that was asked by 5 or 6 students is, what is the meaning of lower segment and upper segment? In a straight line, yes, before that I'll go to one more question. What if it is not touching if a straight line demand curve is not touching the x-axis and y-axis? What we do is, we can extend it and make it meet the x-axis and y-axis. Can you see it? You can extend the demand curve and make it meet the x-axis and y-axis. Okay? Then, 5 or 6 students have asked, what is lower segment and what is upper segment? Please note, this is lower segment and this is upper segment. Lower segment is reaching the x-axis and upper segment is reaching the y-axis. So lower segment divided by upper segment. Then another question that is asked is it possible that necessary goods have unitary elasticity? No. Necessary goods have more or less elastic or relatively inelastic demand. Unitary elasticity is equal to 1. Then, when there is a 10% fall in price, there is a 10% rise in quantity. You know, in the case of necessary goods, we don't buy more when a price is falling, too much more when the price is falling, or we don't buy less when the price has risen. So we respond only less. Unitary is proportionate response. I hope it is clear. So for necessities, it is not unitary elastic. Unitary elastic is 10% decline in price. Your demand will expand 10%. You know, when price of rice, wheat, etc. fall, we don't increase our demand, quantity demanded proportionately. Then another question was asked is, what is the nature of elasticity of demand for salt? Salt is a generic good. Salt is a good on which there is no substitute. Salt is a good on which we spend only a very small portion of your income. And so, salt has inelastic demand. Even if the price is increasing substantially, we buy more or less the same quantity of salt. Then these are the only ones which were not answered in the last class. Now we go to, are you ready to learn now? Come on. I will be giving you, I will not be using PowerPoints in this class, but I'll keep repeating so that you learn in the classroom and go home, right? Then you just have to brush up your memory, what you have learned in the class. So shall we start? Okay. Elasticity was not over. What was over was price elasticity of demand. Different methods of calculating price elasticity. Then we went to income elasticity, which can be both positive and negative. You have to consider the plus or minus sign for income elasticity, because income elasticity for inferior good is negative. Okay. Then for price elasticity, I'm sorry, you forget about the sign, because we will be making a mistake if we are using the sign. So today we are going to cross demand. It's a new concept for you. Cross demand. Cross stands for, come on, the demand for a commodity. We know different variables, price of related commodity. Price of related commodity. And I hope you remember, a related commodity can be either a substitute or a complement. So when the price of a substitute or a complement changes, your demand for that good will also change. So that is the meaning of cross demand. That is the quantity of commodity that a consumer will buy when there is a change in the price of a related commodity, say B. A related commodity can be related either as a complement, you know, complement is both together are used, or as a substitute. Substitute is in the place of good A, I can use good B. So let us see what is cross elasticity of demand. That is how you respond when the price of a related good changes. Okay, without a change in the price of the good which you are buying. For example, you are buying tea. You are buying it because you like tea. But we know coffee is a substitute of tea. And what happens to the demand for tea when the price of coffee goes up or when the price of coffee comes down is what we study under cross demand. So what happens if the price of a substitute, a price of a substitute falls? A price of a substitute falls. Just think of it. A price of a substitute falls. Then the substitute becomes relatively cheaper and people will move to the consumption. Some people, not all people, move to the consumption of the substitute. And so if this is tea, what will happen to the demand for tea? The demand for tea will fall when the price of the substitute has fallen. Okay. And so what is the nature of relationship? When the price of a substitute falls, the quantity demanded of this good will fall. And so what is both moving in the same direction? It is positive cross elasticity of demand, the responsiveness of quantity demanded of tea to a fall in the price of coffee. The response is cross elasticity and the response is positive because both move in the same direction. Okay, suppose the price of coffee rises, what will happen? Then some coffee drinkers will come and start drinking tea. So what happens is the demand for tea rises. So both move in the same direction. And so that is why when both move in the same direction, we say cross elasticity of demand is positive. And so let us repeat, that is relative price of the good whose price is falling, here coffee or tea, whatever it is. So conclusion, the cross price elasticity of demand is positive for substitute goods. You can see it, you can keep your book open. In your book, in page number, please keep your book open. In page number 2.46, you can find substitutes are given in a diagram. Please note, please don't make a mistake when you read this diagram. Price of coffee is given on the y-axis and demand for tea is given on the x-axis. Did you notice when the price of coffee goes up from P to P1, the quantity demanded of tea rises? Positive relationship. That's why it is rising up. I hope it is clear. So let us conclude the cross elasticity of demand for substitute is positive. And let us go to the complements. Okay, complements. What is a complement? C-O-M-P-L-E-M-E-N-T. What is a complement? A complement, if two goods are either brought together, you buy them together, or two goods are consumed together, so that we usually use another term which is joint demand. Joined. These two are used together, so they are complement. Just imagine a situation, you use two goods together, a fall in the X and Y, a fall in the price of good X, right? A fall in the price of good X What will be the consequence? Come on, you can guess because now you know a little bit of economics good now. The right you can find out. Come on. The price of good X falls. What will happen to the quantity demanded of good Y? Come on. The quantity demanded of good Y will be higher. Okay. Because when the price of X falls, there is a quantity demanded of X should definitely for increase. Okay. When price of X falls, quantity demanded of X will rise. And because it is jointly consumed with Y, definitely the quantity demanded of Y should also rise. More of X will require more of Y as well. Okay. And so higher demand for, okay, then a cross elasticity of demand for two complements is negative. Okay, right. When the price of something rises, less of it will be bought, and so the quantity of demanded of Y will also fall. They move in opposite direction, isn't it? For example, when the price of petrol rises, what will happen? The quantity demanded of petrol-driven cars will fall. Okay, price of petrol rises, the quantity demanded of petrol-driven cars will fall. And that is why the cross elasticity of demand, okay, the cross elasticity of demand between between complementary goods is negative. I repeat now, the cross elasticity of demand for substitutes will be positive, and the cross elasticity of demand for complementary goods will be negative. So now question is, should you put the plus or minus sign? Yes, you have to put the plus or minus sign, and seeing this plus or minus sign, you can conclude whether these goods are complementary or substitute. Okay, you see positive, you can say it is substitute. You see negative, you can say it is complement. So plus and minus are over. I repeat, for substitutes it is plus, for complements it is minus. And suppose there are two goods which are not related at all, unrelated goods. For example, because the movie tickets prices are rising, will it affect the quantity of milk that you buy? Not at all. Will it affect your purchase of your notebooks and textbooks? Definitely not. And so, if two goods are totally unrelated, please keep scribbling in your notebook or textbook. If two goods are totally unrelated, there's no relation between these two goods, and so the cross elasticity between them will be negative. Okay, then greater the value of, now let's go back to substitutes again. Greater the value of the substitute, greater the value of cross elasticity, greater will be the substitutability. I'll explain. Closer the substitute. What is closer the substitute? Say two brands of drinking water. Imagine you have two brands. One's name is blue, one's name is green. They are perfect substitutes, isn't it? So if they are perfect substitutes, cross elasticity between them will be infinite. What is the meaning of infinite? Cross elasticity is infinite, means the moment green water raises the price a little, you all of us will shift to blue. Clear? Because they are perfect substitutes. One is 25 rupees, one has increased to 25 rupees from 20 rupees. Green has done that, and blue is still 20 rupees. And you know, green and blue are perfect substitutes drinking water. Perfectly alright. You will not pay 25 rupees and buy green. What will you do? all the green buyers will now shift to blue. What will happen to the demand for green? Immediately fall to 0 or near 0, right? And what will happen to the demand for blue? It will rise substantially. That is why if two goods are perfect substitutes, then the cross elasticity of demand between them is infinite. Then I'll tell you one more method of establishing, for example, interpreting. Higher the value of cross elasticity, closer the substitute. Actually, goods are never perfect substitutes. For example, one toothpaste is a very close substitute of another toothpaste, even though not perfect substitute. For example, you may not like the taste of one. You may be attached to a particular toothpaste. So they are not perfect substitutes. They are close substitutes. And so greater the value of cross elasticity, closer the substitute. Then infinite. Suppose the value of cross elasticity is infinite, then it is just like the water example I said. Okay, right. So let us continue. If two goods are substitutes, their cross elasticity is positive, and if two goods are complementary, then their cross elasticity is negative. Now, take the value, say for example, of coefficient. Suppose you get it as less than 1, then we say it is not very responsive. If it is greater than 1, it is more responsive. Okay. Now let us go to the measurement part of it. That is, we'll have to look at your book because I am not sharing I think you're not interested in PowerPoints, okay? It's very simple to calculate. For example, please go to page number 2.47, the same formula you are using. That is delta Qx by Qx whole divided by delta Py by Py. Finally, it will become delta Qx divided by delta Py. Please make it clear in your book. It is written, you cannot read it properly. Py and then into Py by, come on, Qx. Okay. So the price of Y is important. Quantity of X due to a change in the price of Y. Okay. That is it. Then it is given in your book. All these substitute, everything is given in your book, and I hope it is clear. Okay. Now, shall we try a simple problem? Please note down somewhere. I'll dictate. Come on. The percentage change in X. The percentage change in good X. I'm giving you for simplicity. Let's do it. Percentage change in X. Percentage change in X is equal to 50. Minus 50. What is this minus 50? I told you this plus and minus is important here. Minus 50 will be a fall in price, 50% fall in price. Then percentage change in the demand for Y, 60%. Percentage change in the demand for Y, 60%. I will not give you a hint as to what this is, why one is minus and the other is. Now please interpret it. That is, the price of X has fallen by 60%. Then the percentage change in the demand for another good, it is positive. Did you notice that? It is positive. 60% rise in the demand for good Y because of a 50% fall in the demand for X. What is the answer? Just apply the formula 50 by 60. The answer is minus 1.2, and From this, you have got to interpret the answer. Okay, this is a cross elasticity. It is a coefficient. Did you notice I put the sign minus? Reason is for price elasticity, we ignore the minus sign. But for cross elasticity, for interpreting, we need the minus sign. So minus sign is important. So what does the minus sign mean? We have already done theory. That is cross elasticity will have a minus sign when they are complements. So just make a problem for this. Say for example, the price of good X has fallen so much. So what happened is the quantity demanded of X has risen. Be with me. When what is it that is applying now? Law of demand. Okay. The price has fallen of good X and the quantity demanded of good X has risen, and this good Y is used along with good X. And so you have to buy. When the demand for good X rises, you have to buy more of good Y. Okay. So that is simple. It is one. Okay. So finally we are leaving cross elasticity now. Let's repeat cross elasticity between two substitutes. Please repeat with me. Right. Cross elasticity without looking into the book. Okay. Cross elasticity between two substitutes is positive. Cross elasticity between two complements is negative. Cross elasticity between two perfect substitutes is infinite. Cross elasticity between, come on, what is it that I have not mentioned? Unrelated goods is 0. Greater the value of positive cross elasticity, greater the substitutability. Okay, we will now leave the cross elasticity. You will ask, now we are studying business economics. You will ask, why should a chartered accountancy student know about cross elasticity? As I told you in the first class, you're going to be managers in different places. You're going to be managers in manufacturing places. Some will be CFOs in places. You ought to know every aspect of output production and everything. Okay. And so for managers, you have to know this while fixing your price. For example, if one particular brand of soap, for example, Pears soap, P-E-A-R-S, Pears soap and Fiamma soap are competitors. Okay. Now, Pears soap is planning to change its price. Then it has to be aware that Fiamma is here. Okay. How many people will now move from Pears to Fiamma? I have to be very careful. So I need to measure cross elasticity. You will ask me, how will I measure cross elasticity? Yes, collect some data. You easily get your sales data. When you kept the price of Pears a little higher, it is a lever. What happened to your demand? And how did Fiamma people get more sales? That means some Pears consumer is going to Fiamma, right? And so while changing prices, then what is your alternative? You don't change your price. If you change your price, you're going to lose customers. Okay, you are producing a new soap. How will you fix the price? You have to have an idea about, the price of others and how people will shift to your soap if you keep the prices lower. Okay, other things remaining the same. Okay, now that is why we are teaching you cross elasticity of demand. Now we are leaving cross elasticity of demand. I hope it is clear. You can go home and read. I repeat once more. Between substitutes is positive. Between complements is negative. Between two goods that are unrelated is 0. And then, come on, the last one, greater the value of cross elasticity, greater the response. Smaller the value, smaller the response. Right. That takes us to the last elasticity, that is advertisement elasticity. I don't have to know the commodity through advertisement. No, we'll not buy. That is why Promotion. Promotion is coming from the two terms sales promotion. Sales promotion is also the same. Simply you say promotion, it's actually sales promotion. Advertisement elasticity is you advertise and spend some money, because every firm, you know what is a firm? A producing unit. You know, your amount you sell is a very important determinant of your profit. Only if you are able to sell, you can make profit, isn't it? And so you're interested in selling more and more. How will you make people buy? You say that, okay, our product is very good. How do you say that? Only through advertisements, isn't it? There are different medium of advertisement, different medium. You spend money on advertising. Then you learn or you study what is the effect on sales of this money that I have spent on advertisement. So, for example, if a firm is spending 100,000 rupees on advertising. Okay. Now, next week onwards, you know, people will slowly start coming and asking for the product, and sales will naturally boost up. So you have the sales figures. So this advertisement expenditure and the response to sales, that is advertisement elasticity. That is the percentage change in demand that occurs, the change in quantity demanded or the percentage change in demand that occurs given 1% change or given the percentage change in advertising expenditure. So actually you are measuring the effectiveness of your advertisement campaign. For example, I spent 50,000, I spent 100,000, I spent 10 lakhs on advertisement. And how did it work? Did it bring more sales to me? I have to measure, isn't it? And for measuring, we use the concept of advertisement elasticity. Okay. And it is percentage change in quantity demanded, the very same concept. Okay, you write on top the percentage change in quantity demanded, that is the numerator, divided by percentage change in spending on advertising. That's all. You change your advertising, you find the response, and it's not usually asked for examination, but I will not say it will not be asked, but simply apply this formula, more than enough. Okay, so if elasticity, EA, advertisement elasticity is EA. Sometimes it is capital A, sometimes it is small a, and A stands for advertisement. We know EP stands for price elasticity, EI or EY stands for income elasticity, and EC stands for cross elasticity, and now it is EA. EA stands for advertisement elasticity. Suppose EA is equal to 0. Very bad, isn't it? EA is equal to 0. That is advertisement elasticity 0. When do you get the 0? 0 divided by 25. That is, you have made a 25% increase in your advertisement, but nobody bought anything extra. No percentage change in advertisement. Numerator is 0 and denominator is 25. So what is your answer? 0 advertisement elasticity. What does it mean? There is no response. You did not make any extra sales. But this is something rare. Okay, whenever you advertise, definitely there is greater. And so, suppose you get it as less than 1. What does it mean? 10 divided by 25. Years increased your advertisement expenditure by 25%, but the quantity demanded increased only by 10%. Are you with me? There is only 10% change in sales when you made a 25% change in advertisement. So 10 by 25, it is less than 1. So, less than proportionate to the increase in advertisement expenditure. Advertisement expenditure increases by 25, but your sales increase only by 10%. That is bad. So, we say advertisement elasticity is less than 1. So, should you be advertising again and again and again? As a manager, you have got to make a decision. Should I spend more money on advertisement or not? Right. Because advertisement is not effective. People are not seeing my advertisement, or people are not responding to my advertisement. Okay. Then a third figure is advertisement elasticity is equal to 1. What does it mean? I have increased my advertisement expenditure by 25%. And there is a 25% change in quantity demanded by people. Then 25% divided by 25% will make it 1. And the proportion is the same proportion in which advertisement expenditure is incurred. Right. If it is greater than 1, for example, 50 divided by 25. I have increased my advertisement expenditure by 25%. My sales increase by 50%. Then it is greater than 1. That means the response to my advertisement and response to my sales is substantial. As a manager, will you advertise then? Yes. That is why so many advertisements are coming, because people respond. So advertisement has 2 functions. One is informing that such and such a good is there. The second function is persuasion. Persuade you, come and buy my good. Okay, that is persuasion. Because of information and persuasion, people do really respond to advertisement. That is why the advertisement industry is such a flourishing industry now. Right. So these people who are in charge, these managers or in charge of promotion and advertisement, they measure the advertising elasticity and they see what is the impact. Then only they decide about the advertising budget. That is how much money should be allocated to advertisement. If you allocate, this is the value of advertisement elasticity in your company. You are a researcher in the company. You are asked to find out, okay, you put everything in the Excel file and give the answer. Okay, we put so much money in advertisement and this is so much of increase in sales. Okay, let us advertise more. Not that infinitely advertise. Let's advertise a little more so that our sales will be more. So I repeat, advertisement elasticity is measuring. You are measuring your response to an advertisement campaign. And what is an advertisement campaign? A series of advertisements, spending money, injecting advertisement. That is an advertisement campaign. So what is the response of that? It can be 0, that is people don't respond at all. Percentage change in sales divided by percentage change in advertisement. 0, people do not respond at all to advertisement. 1, people respond proportionately. Less than 1, people respond, but they don't respond proportionately. Greater than 1, people respond more than proportionately. Higher the value of advertisement elasticity, fill in the blanks, happier is the firm. Okay, so why should you, as a chartered accountant, why should you know about advertisement elasticity? Because you are also part of a firm and you ought to know, okay, advertising budget is in the hands of finance people, right? And you will be in the finance department, right? And you have to decide. You will be in the audit department. You have to find out the effectiveness of advertisement. Okay, with that our elasticity part is over. And now we go to, we go to actually the next topic in your textbook is demand forecasting. But let us get a little more used to economics, and then demand forecasting is actually a little bit of, research oriented topic. And as we progress, you are better able to understand after 1 or 2 lessons. Okay, I will not leave it. I'll come back to it. Okay, before that, supply is so much a new word. Economizing means I am trying to make the best use of the time that is available. So before you forget the law of demand and elasticity of demand, I am taking you to a related topic, that is supply. Where are we now? We are learning about market. Okay. The first part is the consumer side. That is the benefit side. Okay. Those who get the benefit, they are willing to pay, and how they will behave is what we have finished learning, right? And now we are going to the seller side. Are you with me? We have finished the consumer side, and now we are going to the seller side. Who are the sellers? The sellers are producers. The sellers of products and services. They are in the supply side. So demand side is the buyer side. Supply side is the seller side. Demand side will talk about the benefit, and suppliers are always interested in finding what is the cost and how much should I produce and supply. Okay, so let us define what supply is first of all. You remember our old term, ceteris paribus. You remember, I hope you remember, ceteris paribus. What is that? Other things remaining the same. Let's go back and see what is demand. Ceteris paribus, the amount of a good or service that a consumer is willing and able to buy, isn't it? But here, now I am talking to about supply. So ceteris paribus, be with me. Ceteris paribus, other things remaining the same. The amount of a good or service. Sometimes for good, they use the word commodity also. So if you find the word commodity, don't be perplexed. Okay. So the amount of a good or service that producers, those who produce, are willing and able. Did you get the 2 words? Willing and able to offer for sale. Offer for sale to the market at various prices during a given period of time. The only difference in word is willing and able to offer for sale. That is only difference. Now we go to the topic of what is the meaning of offer to sell. Suppose a farmer is producing wheat. He produces altogether 1,000 kilograms of wheat. Okay, I hope you can see. He produces 1,000 kilograms of wheat. Should he immediately sell his wheat immediately after the harvest? Should he sell it? No, he should not be selling. You know why? Immediately after harvest, so much of goods will be coming to the market, so much of wheat will be coming to the market. What happens is the price will be lower. Okay, so this agriculturist can manage without selling it immediately. In India, people sell immediately because they don't have money, they have to repay the loans, or they don't have a storage facility. So people do sell. That is about poor agriculture. Okay, but this guy is having 1,000. So he finds the price of wheat per kg is 25. He's not happy with that. So what does he do? Okay, he offers to sell only 500 kilograms. Okay, he offers to sell 500 kilograms and he keeps with him the 500 kilograms. So this is what he offers to sell in the market, or in other words, we can say This is the supply of wheat of this firm. You will be surprised. Why did I say firm? Yes, he is a firm. This farmer, he or she, whoever it is, he is a firm because he is a producer, one who is producing for sale in the market, one who is producing to sell in the market and to make money and profit. Then he is a firm, right? So this firm is offering, come on, other things remaining the same. Every other thing. He has storage facility, the weather is good, okay. Everything else remaining the same. The price of related goods remaining the same. He is able, yes, he has got 1,000 in his granary, right? He is willing, what he is willing and able to offer to the market at a price during the month of September or in the post-harvest month. So please remember, supply is what is offered for sale, by heart. What is offered for sale, ceteris paribus, at a price during a given period of time. Just like demand is always at a price during a given period of time, ceteris paribus. I will go to the next. Supply is also the quantity that is offered for sale at a price during a period of time, ceteris paribus, that is other things remaining the same. Now notice, suppose this man offers 500 kilograms, that is his supply. Is it necessary that he is able to sell all the 500 in the market, okay? He is offering to sell 500. Will he be successful in selling 500? There are other people also who are selling, isn't it? So, this is what he offers to sell. He may or may not be able to sell. He may not necessarily succeed in selling it. That means he is offering for sale. He may sell it or he may not sell it. But still it is supply. Is it clear? Supply is what is offered for sale, not sale as you say in accounts. Okay, not what is actually selling. So what is offered for sale in a market. Okay. Now we will go, so it is per unit of time, and so whether supply is a stock or flow variable. Tell me. When we studied demand, we said demand is a flow variable because demand is per unit of time. This week, next week, okay, we are adding to the market this week, next week. So like that, supply is also a flow of goods during a particular period of time. 500 kilograms in the month of September, 300 kilograms in the month of October at a price 22, 100 kilograms in the month of November at a price 21. Right? So supply is the flow per unit of time. That is why this guy is selling, this farmer is selling 500 kilogram per unit of time here in the month of September. And what is the stock? Come on. His original stock was 1,000. So now you understand stock and supply are two things. Supply comes from the stock. Supply comes from the existing stock. Supply comes from the amount available. How much is the amount available? 1,000. 500 comes from that stock or from the amount available. And what is stock now? Please explain. Come on. You can say it in your mind. Stock of a commodity or stock of a good is the total quantity that is available, right? Like this, many people will have stock, many producers will have stock, okay? Everything together will be the total stock, and what is offered for sale will be the total supply, right? Now, supply is what the person is ready to sell. Note it once more. Supply is what the person is ready to sell. Other thing, okay. So supply is that part of stock which is brought to the market. Supply is that part. I hope it is clear for you. The definition of supply and what is the distinction between stock and supply. Now, just like demand, we will follow the very same principle in which I have taught you demand. Let us go to supply function. I hope you remember the demand function. That is, demand function is the functional relationship between, come on, say, you are saying in your mind, I know, quantity demanded of a commodity, and on the right hand side it is all the determinants of demand, you remember, Px, Pr, Y, P, etc., etc. Then we put one E, that is for all the factors together. Okay. Sometimes they put a Greek letter epsilon. E stood for all the other things because there are hundreds of other things on which demand depends. So, supply function is, come on, Sx. Sx. What will be S? S stands for supply. Sx is a function of, come on, can you guess, come on? It is the price of that commodity. Here it is X, price of the commodity, price of related commodities, T for technology, then C for cost of production, okay, and many more things. I'm writing only 4. You can write anything you like. Actually, you can write any other component you like. Okay, so this is a supply function. There is a functional relationship between right hand side and left hand side. Now we are about to study the law of demand. What we do is, just like we did in demand theory, we keep all these things constant. Okay, suppose there is a K here. Okay, we keep everything else constant and study the relationship between price and quantity supplied. Relationship between price and quantity supplied. Okay, so before we go to the law of supply, we need to learn, come on, the determinants of supply. I'll be giving you some extra points, so get a paper ready to write the extra points because this will help you in your life because you're going to be working as chartered accountants in companies, okay? Now, first determinant of supply is the price of the good. I don't have to explain it because we are going to learn about it. Higher the price, come on, what about this man who is selling wheat? He's not happy with 25 rupees. That is why he is selling only 500. If price of wheat was 50 rupees a kilogram, he would have sold the entire output. Okay, so more will be sold at higher prices and less will be sold at lower prices. Higher the price, higher the supply, lower the price, lower the supply. So price is the first one. That is what we are going to study up in the law of supply. So we immediately move. Next one is price of related goods. Price of related goods. For example, I am a firm which is producing hockey sticks. Okay? Hockey sticks. I find in the market hockey sticks are less demanded, so that the price of hockey stick is less. Can I produce cricket bat also? Yes. Because I am into production, I will do, what will I do? If you are there, come on, you find hockey sticks prices are lower. Cricket batters, sold like hot bread. Then what will you do? It's more profitable for you to produce cricket bats and produce more cricket bats and more hockey sticks and less of cricket bat. So what will you do? Because your production process, etc., will be more or less the same, isn't it? And so you will produce less hockey stick and you will go for cricket bat. Why do you do that? Because you can make more profit. As a producer, your aim is to make profit, isn't it? That is a basic assumption we make. Classical economics assumes that. That is the objective of any firm is to make profit. Plain and simple. Nobody needs to say any lie about it, okay? Your objective is to make profit. And so, if the price of related good is higher, you produce this less and go for the production. And that is how, what is a commercial crop? What is a food crop? A food crop is meant for eating. A commercial crop is for industrial uses brought to the market. For example, rubber is a commercial crop. Whereas wheat or rice, these are all examples of food crops. So food crops, even if the quantity of food crops rise, you have to take now elasticity into account. Will people eat 3 times food? They will not. So when food products quantity increase, the price of food products will come down and your income, your profit will not go up. That is a paradox for agriculture. But when the price of rubber goes up, actually rubber is very much needed for industries, your profit is not going to reduce, just like food crops. So what will people do? They will convert the land from food to commercial crop, rubber. Okay. And so price of related good. Okay. Cultivation here. Rice and wheat. If you can plant the same rice and wheat on the same field, if rice is low price, you will shift to wheat. And if wheat and rice are low price, you will shift to pulses. Okay? Price of related good. I hope it is clear. We have finished 2 points. Price of the good, price of related good. The third one is very important. That is the prices of factors of production. What are factors of production? I am talking this for especially the science stream students. There are 4 factors of production in any production process. That is in any production. That is land, labor, capital, and organization. I repeat, land, labor, capital, and organization. We'll be learning it later in detail about it. Suppose the price of labor, I use the term price of labor, don't worry, it is the same as wages, price for the services of labor. Suppose wage cost is very high, right? In many places in India, it is like that. Wage cost is very high. You go to countries like advanced countries like Europe, US, etc. The wage cost is very high. Hourly wages are very high. So, there are 2 types of products. One where more labor is used and the other where less labor is used. Am I with you? More labor is used and products where less labor is used. These are called labor-intensive methods and capital-intensive methods. Some products have labor-intensive. For example, handloom, handicraft. These are labor-intensive products. Whereas computers and all those hardware and all, it's capital-intensive. So if laborers are very costly, you will supply only less handloom. Okay, you will supply only less of products which are produced with the help of labor. Clear? You will produce more that can be produced with the help of capital, because the cost of production is high when you use labor. So the price of factor of production is important. If price of factor of production goes up, you will produce less of those goods that use that particular factor. This is so in the case of others also. For example, suppose you use a particular raw material. If that raw material goes very costly, you will produce less of that good which uses this raw material. If the price of land goes up very high, what happens? And if your product needs quite a lot of land, you will not produce that product. You will shift to the production of some other product where less land is required. I hope it is clear. The price of factors of production, which is a usually asked question, price of factors of production is important. The moment the cost of production goes up, what is wrong? Come on, let's learn a little bit of theory. What happens when the cost of production goes up? I'll show you this. The difference between price and the cost. Suppose this is price. Okay. Suppose this is price and this is cost. Okay. Price, you have no control on price because it is decided in the market. You have control only on the cost. So how will you increase? This is profit. Okay. The difference between your price and cost is your profit. As a producer, how will you increase your profit? You reduce the cost. Okay. You reduce the cost, then your profit will go up. And so for a good producer who wants to increase the profit, they would like to reduce the cost. Okay. So higher the cost, lower the profit. You will not produce that commodity which uses costly factors of production. Then comes state of technology. State of technology. Yeah, I hope you know that. Better the technology, more will be the supply. If you, for example, you can wash more number of clothes. If one is having a laundry, more number of clothes can be washed at the minimum time, okay, with sophisticated technology machines. But if you are hand washing it, your supply of output of laundry will be less. Better the technology, more will be the supply. The next point that is given, not given I think in your book, is your expectations about price. Your expectations about price. Now that gold prices are going up, I hope you're watching the gold prices, okay? Your expectations, you expect the gold prices to go up to 40,000 per sovereign. Now it is 36,000. Will you supply all the gold in your stock with you? No, you are a gold merchant or you are a gold dealer. Will you sell all your gold at 36,000 and you expect the price to be 40,000? No. You supply less because you expect the prices to go up in future. Suppose you expect the price of gold to fall in future, what will you do? It will be 28,000 next 6 months. What will you do? You will supply more. Are you with me? That is, if you expect the prices to rise, the stock with you, you will supply less. If you expect the prices to fall, you will supply more. Then, next point in your book is government's industrial policy, government's foreign policy. Government wants to encourage industry. For example, ICT, information and communication technology. What will the government do? It will give a lot of tax concession. It will give a lot of subsidy. It will give all type of encouragement to ICT industry. Don't you think the supply will be more? Don't you think the supply of computers, ICT products in India is much more? Yes. That is because of the government's industrial policy. Government wants to produce and sell more of certain commodity. Yes, agricultural policy. Then government's foreign policy. What is foreign policy? Import-export policy. If government imports quite a lot, there will be more supply. If the government is not exporting, there will be more supply in the market. Okay. Then comes, after finishing this, you will take a 2-3 minutes break. A few more points. Okay. Infrastructural facility. I think in the last class I told you what is infrastructure. Everything that makes our production more comfortable and more easier and faster and less cost. Okay. All the roads, transportation facilities, electricity, communication facilities, computer connectivities, internet, all these are examples of infrastructure. Better the infrastructure, more will be the supply. Poor infrastructure, less will be the supply. Then comes, have you heard about monopoly? Suppose there are only few sellers in the market. I think this is a new point. There are only few sellers in the market, supply will be less. There are more number of sellers. Two sellers or monopoly, there will be less supply. Suppose there are more number of sellers, then there will be more. Okay. Then, what about natural factors? Suppose there is a good weather. Yeah, good weather. All these are multiple choice questions. Okay, we will go to that when we go to movement along the supply curve. We are going to that in the next 1 hour. Natural factors: weather, good weather, more supply of wheat. Flood, less supply. Okay, so good weather, natural factors. Then abnormal or extraordinary situation. This is also a new point. Like COVID-19 that we are having now, come on, what about the supply? Supply is reduced. Suppose there is an abnormal situation like war, famine, okay, then supply will be less. Right. Suppose there is industrial peace, there is no dispute in the industry. Every day we are working, right? The industry is working every day, right? Supply is more. Suppose there is no political conflict, there is political stability and peace. Yes, supply will be more. And so, these are the factors that determine supply. And coming to the last one, that is objectives of the firm. Objectives of the firm, I need to explain a little more about taxes. Objective of the firm is, we teach in economics that is objective of the firm is profit making. Here also I said the objective of all the firm is to make profit. But there are theories originated in Western countries. For example, we have an Indian culture where we say Loka Samasta Sukhino Bhavantu, isn't it? That is our culture. Loka Samasta Sukhino Bhavantu. We will not say that we should be exploiting somebody else and making more money, because that is not our culture. Okay, like that, there are 9 versions of theories which say firms do not necessarily try to make profit. These are true also. Okay, but at fundamental level, in your foundation level, they'll be teaching you firms want to make profit, but at higher level, they'll be teaching you firms have many objectives. So I can tell you one example. There is a Baumol's theory, B-A-U-M-O-L, Baumol's theory which says firms try to maximize sales. Okay, they want to maximize their sale and when minimum, subject to a minimum profit. Okay, they want to maximize their sale. So suppose the firm wants to maximize sale, their supply will be more. Suppose the firm wants to make a lot of profit. He's a monopolist. He will reduce the quantity supplied and try to make profit. Okay. And so, with that, these are the determinants. I told you about a little more about tax. Suppose the government is heavily taxing. What will excise duty? All types of taxes the government is putting. All types of production taxes, product taxes. What will happen? The cost of production will go up. Tax on raw material. Minimum Wages Act. All these government policies will increase the cost, reduce your profit, and more people won't enter into production of this, and so the supply will be less. So a quick recap and then a break. Okay, determinants are price of the good, price of related good, price of factors of production which determines cost, state of technology, then expected price, then government's industrial policy, government's tax policy, government subsidy policy, government's export policy, government's import policy, infrastructural facilities, market structure, number of sellers, are you with me? Number of sellers, objectives of the firm, then natural factors like weather, abnormal conditions like COVID, then industrial peace, political climate. Okay, all these are determinants of supply. Now you can take a 2 or 3 minutes break and we come back and go fast to the law of supply and finish it today itself. In the meantime, I will check your queries. Yes, I am back. Yes, I am back. Okay. Welcome back, my dear students, to the class. I'm happy you're asking questions. Then, yeah, please. Good questions asked. First question is, what is arc elasticity? That is by Mayank. I have already explained Mayank. Then next question is, will paper 4 and chapter 4 and 5? Yes, every single lesson will be taught by ICAI. You don't have to worry at all. Every single word will be taught by ICAI. ICAI will care for you, so please assure. Then in price elasticity, inverse relation, yes. Then another question is, normal good, yes, that is, Ruchi is asking what is normal good. Normal good is that good where your income goes up, you buy more of it. That is only definition of normal good. Then question is how to prepare notes for business economics. Actually, you don't have to prepare much notes. If at all you are preparing, please prepare it based on the textbook. Each sentence in the textbook, you have to be clear about it. Okay, that's all. You don't need much notes, but if you're particular, please prepare the notes from your textbook. Then Shibam Agarwal is asking, given good. Shibam, it is, given good is, it is an exception to the law of demand. You buy more of it when the price goes up. It is given goods have 3 characteristics. One is it is an inferior good. Inferior good, that is, it is ordinary food that is bought by ordinary people. Second characteristic is substantial part of money of poor people will be spent. 70% of your income. Think of poor people. They'll be spending a lot of money on wheat and, staple food, ragi, millets, etc. And when the price of ragi, millets, etc. go up, what happens is they're so poor, they can't afford vegetables and other superior good. So what will they do? They will buy more millets and ragi to fill their stomach, okay? And that is given good. So all inferior goods are not given good, only those inferior goods on which poor people spend substantial portion of their money. I hope it is clear. Then Rohit Agarwal is asking cross elasticity. In business, cross elasticity is very important. I'm not simply teaching you because people do calculate cross elasticity when they are launching the product, when they are fixing the prices, when they are changing the prices, especially in consumer, these white good industry, these consumer durable goods and toiletries and things, almost everywhere they use it, and so you will find it very useful. Okay. Kajal is asking me, price will increase, demand will decrease, and production of goods will decrease. Kajal, we are only coming to that price determination. Maybe after 2 classes, then it will be clear for you. Then share screen of presentation. Yes. Why cross elasticity unrelated? Then it is 0. Because as I told you, there are goods which are not related at all. And so the price change will not affect the demand for example, I used to tell your textbook is demanded by you. Milk prices increase, your textbook demand is not going to change, isn't it? Then what is law of diminishing marginal utility? Nikita, we are coming to that. Then that is the next class. Rohit, consumer behavior, we are coming to that. Please explain infinite cross elasticity. Infinite cross elasticity is, I told you, 2 bottles of water which is exactly the same except in the name, red and blue. So red and green, okay, or blue and green, okay. Green raises the price, 5 rupees per bottle. You will not buy green. Green's demand will become 0. Infinite change in demand. All of us will move to blue. So the demand falls to 0. All of us moving to blue. That means infinite change. Okay. Then next question is, zero elasticity. That is infinite. Zero cross elasticity, I have already explained. That is things which are not connected. Then what is total outlay method? That is, you are measuring elasticity based on the total expenditure on the commodity. There are only 3 things to remember. If total expenditure remains the same, elasticity is equal to 1. If total expenditure is increasing, then it is more elastic. If total expenditure is decreasing with a fall in price and increasing with a rise, then elasticity is less than 1. Just prepare a note from the textbook for these 3 statements are enough. Okay. Then cross and advertisement elasticity. Agarwal, it is cross elasticity is, when responsiveness of demand to changes in the price of some other commodity, a related commodity, that is cross elasticity. Advertisement elasticity is the responsiveness to advertisement. How? So both are different things. One is to the change in price of some other commodity. The other one is advertisement. Okay. Why should we study advertisement elasticity? We do not know who is that. Okay. Deepa, you will not know. You will sometime be manager in charge of advertisement of a particular company. You ought to know about advertisement elasticity. Or you are the finance manager. You should know about advertising budget. How much money should be given to others for advertisement? Because if it is not effective, you as a finance manager, you're not going to give money. I hope I am clear. Okay. Now consumer behavior is not left out. I'll be teaching you that. For reasons I told you now, it is very important. We are coming to that. COVID times, people are substituting their demand for necessities because they have the mindset that there will be, yes, that is one of the factors determinant in demand. If people expect shortages, okay, they will buy despite the fact that price is going up. That is an exception of law of demand, okay, during the times of COVID exception. Explain cross and advertisement elasticity. Yes, I have explained. I'm happy you have asked very good questions. Now we come to class, okay. We are going to the law of supply. Don't be afraid. Don't think that I will not be teaching you. Yes, I'm going to teach you consumer behavior next class, right? Now we go to the law of supply. It is very simple. It is exactly the opposite of law of demand. Okay. So say it with me. Other things remaining constant. The quantity of a good produced and offered for sale. Remember, other things remaining the same. The quantity of a good produced and offered for sale will increase. Just notice quantity will increase as the price of the good rises and decrease as the price falls. I'll repeat, ceteris paribus, other things remaining the same, the quantity of a good produced and sold will increase with an increase in price and decrease with a decrease in price. Clear? So what is the nature of relationship? When price goes up, the quantity also goes up. And when price comes down, the quantity will also come down. So what is the nature of relationship? It is positive relationship. What was the nature of relationship in demand? It was negative or inverse relationship. What was the shape of the demand curve? Downward falling from top left hand corner to the right hand corner or quadrant 1, right? That is that quadrant 1. Then, what will be the shape of the supply curve? Exactly the opposite. I will draw both together on the board. That is, if this is the demand curve, then supply curve will be exactly opposite. Okay, because it shows direct relationship. As price is rising, quantity is rising. Let's go in detail. Now that the comparison is over, let's go in detail. Law of supply can be stated as higher the price, higher the supply, lower the price, lower will be the supply. Nature of relationship is, come on, say in your mind, direct. Nature of relationship in the case of demand theory is inverse. See, buyers want to buy at the lowest possible price. Sellers want to sell at the highest possible price. Okay, that is it. And so, just like we had a demand schedule, we can have a supply schedule. What will be a supply schedule? A supply schedule, just like demand schedule, is a table. Table is one with rows and columns, right? A supply schedule shows the relationship between price and quantity supplied. So how many columns will be there? There are only 2 columns. Of course, ABCD we will put, but you can open your book, okay, instead of me writing the whole supply schedule on the board, okay. You have a supply schedule in your book, page number, that's page number 2.75. Okay, I can write if you want. I can write another supply schedule as an example. Okay, if you look in your book, your supply schedule says as price rises from 1, 2, 3, 4, 5, quantity supplied in kilograms rise from 5, 35, 45, 55, 65. Okay, a supply schedule has 2 columns. First column shows the price and the second column shows the quantity supplied. Okay. Now you remember if you convert this, for example, I will draw it, okay? The price is 1, 2, 3, 4, and 5. The quantity supplied in your textbook is, come on, 5, 10, 15, 20, 25, 35, 45, okay, 55, okay. When the price is 1, the quantity supplied is 5. Should be putting only points, okay. When the price is 2, it is 35. Okay, it is 35. When it be a straight line, it will be a line. Okay, it is given in your book as SS1. Just notice in your book that first S closer to the y-axis looks like a dollar. It is not a dollar. Please mark it as SS1. Those broken lines are falling on it and it looks like dollar. That is all. Okay. So you get a supply curve which is a rising curve. Did you notice it? Rising curve. And the supply curve starts at your 1. Okay, did you notice it starts at 1, near the 1. Okay, I am going to tell you something more about it. A supply curve, it can definitely touch the x-axis. Sorry, y-axis, no problem. Please note it, you will need it further and further. A supply curve that is touching the y-axis only means, can you see the supply curve is touching the y-axis? It only means if the price is less than 1 rupee, there is no supply. It is 0. Look at the diagram. If the price is less than 1 rupee, you will not supply anything. There is nothing wrong in a supply curve touching the y-axis. Okay, the supply curve. So in economics, we call it the reserve price. Just write in your book. Reserve price. That is the price below which you will not supply anything. I'll tell you an example. You become a chartered accountant. What is the expected salary? You say, okay, I expect 1.25 lakhs. That is your reserve price. You will not supply your accounting or auditing service less than 1.25. Okay. So your supply curve will start at 1.25 lakhs. Not below that. Right. So this is a supply schedule. I hope it is clear and the supply curve. Now answer my question. If I'm standing in, okay, I cannot see you, but still, when will you get a linear supply curve? You can go home, I'll give you a homework. Just write on a piece of paper. Price, first column, 1, 2, 3, 4, 5. Quantity, next column, 60. Oh, I'll put a better number. Please delete it. Okay. First column, price, 1, 2, 3, 4, 5, 50, 60. Did you notice? 1, 2, 3, 4, 5. Price, quantity is 20, 30, 40, 50, 60. Just go take a plain piece of paper or a graph paper. You don't need a graph paper and plot it and see what type of supply schedule, supply curve do you get. You will get a straight line supply curve. Okay, if you don't get a straight line, you have not a okay. Now I am making a distinction just like demand, individual demand schedule and market demand schedule. I am making a distinction between individual supply schedule and market supply schedule. And what will be individual supply schedule? Individual supply schedule is the supply schedule which refers to an individual firm. I repeat, what is a firm? A firm is a single producing unit, whether agriculture or industry or a small tea shop. They are also firm. They are also firm. Okay. And so, what an individual, let us give him a name, Ram. Okay. Ram at what price? At all these prices, or let us say Rohit. Rohit, I remember your name, Rohit. At prices 1, 2, 3, 4, 5, what will be the chocolate eaten by Rohit? 1 rupee, 2 rupee, eaten by Rohit. That is your individual demand schedule. Like that. Suppose you are producing and selling chocolate. How much will you sell for 1 rupee? 50 chocolates. 2 rupee, 100 chocolate. 3 rupees, 200 chocolates, like that. Okay. And so that is your individual decision. Suppose there are 100 producers of chocolate, like Rohit, there are so many, Anushka is also producing, and so many students in the city who are sitting in the class are producing chocolates, and there are altogether 100 producers of this particular chocolate. And so I will have a market supply schedule. How much will Rohit sell? How much will Anushka sell? How much will Gauri sell? How much will Nikita sell? So like that, under each person, 100 columns I will write, then horizontally sum up, and so I will get the total market supply. At price 1, I will sell 1,600 chocolate. At price 2, all the students, 100 students together will produce and sell 2,800. At price 3, 4,600. At price 4, 8,000. At price 5, 12,000. Did you notice? Now we do not need all the 100 columns. We need only the first column and the last column. Okay? And that gives you the market supply curve. What will be the market supply curve shape? Just like this only, little flatter. Okay? It may be straight line. It may be a curved line depending on the values, the proportion of values. Okay? This is a market supply curve, and that is obtained by adding all the supply curves. I hope it is clear. You get a market supply curve by lateral summation or horizontal summation, and the market supply decides what is the total available goods in the market. If all the gold sellers now are selling gold at 36,000, then that is the market supply of gold. And if all the buyers of gold buy this much for 36,000 per sovereign, that is the total demand for gold. Okay. And so we have the market supply curve, just like the market demand curve. It is obtained by lateral summation. Now the next thing that we studied is movement along the supply curve. You remember? Movement along the supply curve. You remember, you can recall movement along the demand curve. Like that, there is movement along the supply curve. I will draw it. I don't know whether it is clear for you when I draw. Okay, this is a supply curve. Then price is P, quantity supplied is 40. Then price is P1, quantity supplied is only 30. Did you notice that? When price is P, quantity supplied is 40. When price falls to P1, quantity supplied decreases. Did you notice the word that I said? When price falls, always attach price and quantity. In multiple choice questions, you know, they will not use the term quantity. Then if you choose that, it is wrong. Okay. And so when price falls, the quantity decreases. Price, quantity, always together. The quantity decreases. What did you do? Come on. You have slided down the supply curve from A to B. You have slided down the supply curve from A to B. This is, come on, you say in your mind, a contraction of supply. A contraction of supply is sliding down a supply curve. What was contraction of demand? Contraction was sliding up, but this is opposite, okay? So don't make a mistake. Contraction is sliding down a supply curve. And what is expansion? Come on. The price, suppose instead of falling, the price rises from P to P1 to P. What will happen? As a seller, you will increase the quantity supplied. You remember our earlier wheat production man, the farmer who was producing wheat. What will he do when wheat prices increase from 25 to 30? Come on. If this is 25 and this is 30, he is sliding up on the supply curve. Now let us come to the conclusion. When you move up and down the same supply curve, keep it in your mind due to changes in price. Okay, whenever price changes, the law of supply applies and you either slide down the supply curve, in which case the supply is less at a lower price, or you slide up the supply curve, in which case you're supplying more at a higher price. Okay, right. Now I repeat, when the change in supply is due to, when supply changes because of changes in the first determinant. What is the first determinant? Price of the commodity. We say there is an expansion or contraction of supply, and we move up and down the same supply curve. Okay, is it clear? Then due to change in price, there is a change in quantity. We don't have a separate demand curve. We move up or down on the same supply curve. Now I will take you to another, for example, now expansion in supply and contraction in supply is clear, I suppose. It is given in your textbook, page number 2.76. Next one is increase, just like that's why I'm teaching this one immediately after demand. Now you have not forgotten it. Now suppose price does not change. What did you study now? When price changes. And price is the first determinant of supply. Okay. And now we leave that. We are clear when price changes, quantity changes, and we slide up and down on the same supply curve. We call it a contraction for a reduction in quantity supplied due to a fall in price. We call it an expansion because when there is a rise in quantity supplied because of a rise in price. So keep it in your mind. Now we are going to other factors. You remember determinants of supply, price of related good, weather conditions, government policy, cost of production, or hundreds of other things, isn't it? If any of these change without any change in price, okay, so price remains the same, say at 10 rupees. Price of something remains the same, and earlier the quantity supplied is 40 chocolates, okay. 40 chocolates. The quantity supplied is 40. Right? Now this year, cocoa output is so high and so more cocoa is available for chocolate producers. Or cocoa eating chocolate has become fashion among youngsters. Or there is an advertisement saying that eating chocolates will make young boys and girls, young girls very pretty and young boys very handsome. Come on. Then definitely more chocolates will be eaten, isn't it? Right. Now, forget about the second part. That is only to keep you awake, I said. Okay. And now, suppose cocoa is more or production is more, there is a better technology, all the other factors can change. Okay. And suppose more is supplied because of good weather, more cocoa is supplied, or because of whatever it is, more is supplied at the same price. Instead of 40, We have a better technology for chocolate production. Okay, that is easiest. We have a better technology for chocolate production so that for 10 rupees, you can now produce and sell 50. Look at this 50, it is on a different supply curve. The supply curve has shifted to the right, not because of any change in price. The price remains the same at 10. Clear? But it has changed because of a better technology. It has changed because of better cocoa output. It has changed because the producers are happy to produce more. It is because more number of chocolate producers have entered the market. Okay. Or it is because we have imported more chocolates, or maybe any of the other factors can change. And then this is increase in supply. Please note, increase in supply is more at the same price. Please note it, increase in supply is more at the same price. Price remains the same. Without any change in price, you find that more supply is there we call it increase in supply, not increase in quantity. Then do you say increase in quantity? Then price rises and more supply comes. We call it increase in quantity supply. But this is an increase in supply. Suppose there is very bad weather, or there is a war, or whatever it is, unusual situation, any of the factors, what will happen? The supply will reduce, okay? Earlier, because when weather was good, we used to produce 400 kilograms, but since weather is bad, the prices remaining the same. Since weather is bad, we can only produce 250. At the same price, 35 rupees per kilogram, you are now producing and supplying only 250. Why is it? It is not because of price, it is because of bad weather. Or it is because the price of a related good has increased. It is because the technology has become outdated. Okay, for various reasons, you can supply only less at the same price. So let us club these two things together. Increase in supply means more at the same price, and decrease in supply means less at the same price. Okay, when increase in supply takes place, the supply curve altogether shifts to the right. When decrease in supply takes place, the supply curve altogether shifts to the left. So let me repeat, for expansion and contraction, the movement is along the same supply curve. For increase and decrease, we have a different supply curve. For increase, there is a rightward shift, and for decrease, there is a leftward shift. Okay, now that you have not forgotten demand it is, okay. So shift in supply curve is, fill in the blanks, come on. Shift in supply curve is due to change in factors other than price. Movement along the supply curve is due to changes in price. Okay, shift in supply curve means a totally different curve is coming. Okay. Now that takes us to very simple it is. We go to elasticity of demand. Elasticity of supply. I'm still talking about, I'm mistaken. Elasticity of supply is exactly like elasticity of demand. Absolutely nothing more to study. In the place of quantity demanded, you need to put quantity supplied. That's all. So first you can look into your book if you want. The first method is, come on, percentage change in quantity supplied. Don't make a mistake. Percentage change in quantity supplied divided by percentage change in price. Okay. And finally it becomes delta Q by delta P into P by Q. but that gives a lot of confusion, right? And so we apply our formula, which one? Q1 minus Q2 divided by Q1 plus Q2, that midpoint method. Please remember, the sign will be positive. So you don't have to worry about the negative sign or the positive sign or whatever it is. The relationship is direct, and so elasticity of supply will be always positive. There is nothing like negative elasticity. Okay, and so the first one is percentage method, percentage change in quantity supplied divided by percentage change in price. You might ask which formula to use. Actually, when you work out many problems, looking at the wording, that is like that in mathematics, isn't it? Looking at the wording, you know which method is to be used. Suppose sometimes the problem will be so simple that you are given percentage change in quantity supplied is 20 and the percentage change in price is 10. What is the elasticity? Very simple. Otherwise, you will have to calculate the percentage, and then the funny thing about this is, when you apply different formula, you get different answer. And that is a challenge in answering the elasticity. Because if you are applying that delta Q by delta P into P by Q, that and percentage method, sometimes the answers might slightly differ. Okay. So don't worry about it. Look at the answers, and if you're not getting the alternatives given, none of the alternatives given, then go back and see which formula to apply, because all the formula right? So let's go to then here also point elasticity and arc elasticity. So don't be confused, I will repeat. Point elasticity is when you take elasticity at a particular point, and arc elasticity is when you measure elasticity at two different points in this portion of the arc. And whatever you did in demand, so for example, the same point elasticity method, dq, that is derivative, you remember, dq by dp into p by q. Only difference is it is supply, right? Q stands for quantity supplied and not quantity demanded. Exactly the same. Now we go to without going much into it, because you are clear about now let's go to types of elasticity. You can open your book, okay? All the calculations, one example is given there. Then types of elasticity. Yeah, we have to be very, very clear about it. So let's take maybe 10 minutes and discussing this. The first type of elasticity given in the book, we'll go in that order. Perfectly inelastic. Did you notice the curve? Perfectly inelastic. That is, this is actually price elasticity of supply that we studied, right? So, perfectly inelastic. What will you mark on the y-axis? Price. What will you mark on the x-axis? Quantity. Just like demand. Okay. Price. Okay. This is a supply curve, which is a vertical straight line parallel to the y-axis. A vertical straight line parallel to the y-axis. What does it mean? If price is 100 rupees, quantity supplied is OS. Price is 200 rupees, quantity supplied is OS. Price is 1000 rupees, quantity supplied is OS. The quantity supplied does not respond at all to a change in price. So elasticity of supply, or ES, equal to 0. That is, percentage change in quantity supplied is 0. Percentage change in price denominator can be any number. Okay, there is no change in supply. You can recollect when I taught you about demand, I said Even a cardiac surgery, that is example I said, a cardiac surgery that will cost you crores, I will not go for it, right? So, elasticity of demand 0 is unrealistic. There is nothing like that elasticity is equal to 0 in real life. Then you will ask me, why did you say this? Because elasticity of supply is equal to 0 is something real. There is something reality like that. What is it? I'll tell you an example. Can you imagine an example where supply will not change at all? Its quantity is so fixed that whatever is the price, it remains the same. Let me see. Have you heard of Leonardo da Vinci? Have you heard about Michelangelo? Okay. Have you heard about great painters? Whatever be the price, they're all dead and gone, isn't it? Whatever be the price of these pictures, can you increase the supply? Think about the curios sitting in your place, in your in all those exhibition centers, in all those places of visit that you go to. Okay, all those very expensive museum where they keep all these all these ancient things. Can its supply be increased? Whatever is the price, no, it cannot increase. And so, perfectly inelastic supply is a reality. It is really existing in the world. Okay, so whatever is the price. The next one is unit elasticity. What was the shape of the demand curve for unit elasticity? It was a rectangular hyperbola. Here, unit elasticity is also, it is not a rectangular hyperbola because it has got a different shape. Okay, a unit elasticity curve is, the proportion remains the same. For a 10% rise in price, there is a 10% increase in the quantity supplied. For example, then the formula will be percentage change in demand is 10% and percentage change in supply is 10% and percentage change in price is 10. So 10 by 10, 1. 25 by 25, 1. 40 by 40, 1. So unit elasticity is on the x-axis and y-axis, that proportion remains the same. For example, this is supply, there is a 10% change in, there is a 10% change here, there is a 10% change in quantity supplied. Both are the same. That is delta P, the proportion is the same as delta Q. Okay, that is elasticity is equal to 1. So what are the ones we discussed? That is 0 elasticity where there is no response and 1 elasticity where the response is just same proportion. Okay, 10% divided by 10%. Clear? Now we go to a third one, which is less elastic. So remember, whenever elasticity is equal to 1, if we extend the direct supply curve, it will come and meet in the origin, 0. Right? Any elastic curve which has an elastic supply representing an elastic supply which is equal to 1 will reach 0 if you extend it, or reach the origin if you extend it. Now we go to the next, that is less elastic curve. Okay, less elastic supply curve. Now I draw a curve like this. This is a supply curve. You can also draw a curved one. I am drawing a straight line. And you find, come on, the price is changing substantially. Okay, that is here. Okay. From P to P1, the price is increasing substantially, but the quantity supplied will respond only less. The price is increasing substantially, but the quantity supplied is responding only less than proportionate. Okay, that is That is elasticity less than 1. If you extend it, it will meet the x-axis. That is one criterion. Okay? If you extend an inelastic curve or less than 1 elastic curve, it will meet the x-axis on its positive side. This side is positive, isn't it? It will meet the x-axis. I hope it is clear. Elasticity is equal to 1. That curve, when extended, will reach the origin 0. Then this curve is, when the elasticity is less than 1, you will have a steep supply curve where you show the response is proportionately less. The response of supply, quantity supplied, is proportionately less. And so, because it is steep, if it is extended, it will reach the x-axis. Okay? And then you find it is a steep curve. And the fourth one is, if elasticity is greater than 1. Okay? Elasticity is greater, or supply is greater than 1. It is a flat curve like this. Elasticity of supply is greater than 1. It's a flat curve like this. That is, for a small change in price, be with me, come on. For a small change in, okay, there is a more than proportionate. For a 5% change, I am simply writing, I did not measure. For a small delta P, which is 5%, delta Q is 25%. So 5 by 25, okay, that is 25 by 5. So elasticity is 5. Okay, and if you extend this curve, come on, where does it meet? It meets the x-axis on its negative portion. From here, it is negative, isn't it? This side, it is positive. It will go and touch the x-axis in its negative portion. So I have now mentioned 4, that is perfectly inelastic demand curve, which is a vertical straight line parallel to the y-axis. Elasticity is equal to 1, a curve that if extended will reach the origin. Then an inelastic curve which is less than 1, where elasticity of supply is less than 1. If it is extended, it will come and reach the x-axis. And a more elastic curve which is flatter, showing more than proportionate response, and if extended, it will come and meet the x-axis in its negative portion. And there is one more. Can you guess what it is? The next one is infinitely elastic. What will be this infinitely elastic or perfectly elastic? You can guess what will be the shape. Come on, because we have done infinitely elastic demand curve. It is a straight line parallel to the x-axis. So I will now draw an infinitely elastic supply curve. Yes is infinite elastic supply curve. Nothing is supplied at a lower price. Suppose price is 10 rupees. The coffee shop near your school, they sell coffee at 10 rupees. Okay? Right? Nothing is supplied at 9 rupees. Coffee's price is 9 rupees. They will not supply anything. A small increase of 1 rupee for the coffee in your place. Okay? The supply will, isn't it? If it is 9, okay, 0. If it is 9, no part of the supply curve is there. So if it is 9, supply is 0. A small increase in price makes the price 10 rupees. And what happens? Coffee supply increases, okay, quantity supplied increases. Please remember, quantity supplied increases from 0 to an infinitely large amount. That is, producers will supply as much as they can. Okay, at this 10 rupees and nothing will be supplied, okay, at a lower price. And that is perfectly elastic supply. Okay, now you will ask me, why did you study? Okay, let's just sum up. Elasticity is equal to 0. It is perfectly inelastic. Elasticity is less than 1. We call it relatively inelastic or inelastic. Elasticity is equal to 1. We call it unit elasticity or unitary elasticity. Elasticity is greater than 1. We call it relatively elastic. Elasticity is infinite. Okay, that is this last curve that I have drawn. It is all that supply changes are immeasurable. And there are many factors that influence supply. That's not there in your textbook, but you study it for them GK also. I will take 2-3 minutes and tell you, supply will be more elastic. Okay, when there are many sellers, right? We can easily, when price changes, we know there are many sellers selling it, so that they will sell more. Supply will be more elastic if technology is good. Supply will be more. But now tell me, what does it mean? Yes, this is one point you've got to remember. What does it mean, a rising supply curve? Just as a falling supply curve, please be with me. Just as a falling demand curve means more will be bought only at lower prices. Please be with me. A falling demand curve means more will be bought only at lower prices. What does a rising supply curve mean? A rising supply curve means more will be supplied only at higher prices. More will be supplied only at higher prices. You cannot supply more at the same price, because if you have got to produce more, your cost will increase. And only when the buyer is willing to give this higher price, we will produce and sell at a higher price. Okay. Now elasticity. Elasticity is more, more when technology is good. Elasticity is more. Elasticity is, that responsiveness. For example, very sophisticated good. Production process is very difficult. Okay, then elasticity will be less. Very easy production process like making a cup of coffee. As price increases, supply will very fast respond. Then, suppose a firm has a lot of production capacity. They can produce 100, but they are only producing 50 now. That is, there is production capacity. Clear? This I am telling you only for GK. And so whenever the price rises, they can use this 50% capacity which they are not using. And they can increase the supply. But suppose production capacity is less, okay, the supply cannot be extended like that. I think with this we stop the supply, and it is price determination. I need to look into your doubts. Okay, I'm good. Okay. Yeah. Oh God. What? Okay. What type of question will be asked in the examination? Only multiple choice question. Okay. Right. Come on. Can you tell cross elasticity demand illustration? Yeah, problem. I think problem. I'll give you one problem called complement because we don't have much time. Okay. Elasticity is, once again, please explain. I'll explain. Elasticity is the responsiveness of quantity. Okay. Here now that I have finished supply, demanded or supplied, okay, to changes in one of the variables, that effect. As you go to higher classes, elasticity will be very, very often used, because for intermediate also you will do it. Okay. Then downloaded files, okay, you can open all that. Please check with your, all these technical issues, please tell the ICAI. They will definitely. What is the difference between stock and supply? Stock is the total that is available. In our farmer's example, he has 1,000 kilograms of stock, but he is supplying only 50. So please remember, good that you asked this. Okay, that is, your supply is usually less than or equal to your stock. Your supply cannot be greater than. So this farmer can supply only what he has as stock. Good that you have asked. Okay, so supply is either less than or equal to stock. That person, the farmer we were talking about, or the chocolate that our students were making, right? You can sell only what you make. That is your total stock, nothing more. But you can always sell less if you're not happy with the price. Okay. Then what is the difference between quantity demanded and demand? Okay, quantity demanded is the amount of good or service that you are willing and able to buy at a price during a given period of time. Ceteris paribus. Please remember, in economics there is only one definition for things. Okay. Then next question, stock and supply. I hope it is clear. That is, who's that? I can't read your names, and because this is messages such a small letter. Okay, so please excuse me, I cannot say your name, right? Then my God, one I cannot read at all, some other language. Okay, that is TQEW, I cannot read that. What is the difference between quantity demanded? Yes, that is quantity demanded. And demand is desire backed by ability and willingness to pay. Usually, demand and quantity demanded are interchangeably used. That is, you can use demand in the place of quantity demanded. For example, demand for coffee is the same as quantity demanded. Usually, we use it, okay, interchangeably. You can exchange it and law of diminishing marginal utility. Yes, I am coming to that. Very good student you are. I can't read your name. I must read your name. Yeah, it is from Bihar. Priyanshu Kumar from Bihar. Yes, I have not forgotten Priyanshu. That first point will be discussed only after I teach you diminishing marginal utility, which is the next class. My God, what is monopoly, my dear child? That is in the 4th chapter. We'll deal with it later. Anyway, I am so happy. Oh, I said the word monopoly. Very good. You are listening. I am happy. Monopoly is there is only one seller in the market. Yes, there is only one seller in the market, right? So that he decides what is the supply. He wants to restrict the supply. He can restrict the supply. Okay. Oh, very good. I am happy that you asked. There are two sellers. You call it duopoly, right? There are few sellers, we call it oligopoly, and all that you're going to study in 4th chapter. Okay, ma'am, I am in class 12. No time. Ma'am, I am in class 12, and can you explain fact of national income? Not in this live class. You can call me, I can definitely tell you. Then the market structure. Yes, market structure is, when you look at the market, how many sellers are there? What is the nature of competition? If there is competition, there will be more supply. I will tell you one example. That is, you are very young, but we have lived long enough. You remember, there was only one supplier of telephone services in India. That is the telecommunication department, the current BSNL. And we had to wait 8 to 9 years to get a phone connection. The supply was less. Cooking gas, supplied only one by company. We had to wait 35 to 40 days. Okay. Whenever there is competition and more people enter the market structure is different when compared to one person in the market. And when the market structure is with more number of sellers, naturally supply will be more. Good. I'm happy you are attending properly. Okay. Now, how can you do that? Okay, delta dou values. My God, I can't understand. Delta dou value. Okay. Right. Ma'am, please, you only teach all other chapters. I'm sorry. Okay. Can you please explain how unrelated goods have? Okay. Unrelated goods will have negative elasticity. No, unrelated goods, those that, yeah, this is from Hyderabad. What is your name? Yeah, Shirsha. Shirsha, unrelated goods have actually zero cross elasticity, right? Zero cross elasticity. Now, what relationship between demand and supply? Yeah, that is what we are going to learn in the next class. We'll start with that. One is direct, that is supply, and the other is inverse. These two curves I'll show you in the next class how they intersect. Okay. What type of question will be asked? Ma'am, please send notes and explain. Okay, not government infrastructure. Infrastructure is on all these things like electricity supply, telecommunication, internet, water supply, information supply, okay, knowledge, research, all these are, okay, okay. Then, right, what type of question? Yeah. Then what is the difference between conspicuous and speculative? Yes, good. Conspicuous goods are, I am consuming it just to show off. Suppose I stand here wearing 10 diamond necklaces, okay, or 1 diamond necklace, that is a conspicuous good. Then what is the next you would be asked? Okay. And speculative good is, if I buy a commodity so that I can sell it later and make money. Suppose I go to the market and buy a gold market and buy 10 sovereigns and keep it because I expect the gold prices to go up, then that is a speculative. I hope it is clear. Conspicuous is to show, I said diamond necklace, and speculative is to make money from future changes in price. I buy shares in the stock market because I expect Jio shares to go up. Okay, so I want to make money in the future by selling Jio shares or Reliance shares or Tata shares. That is speculative. Is it clear? I hope it is clear. Then why price effect is equal to substitution and income effect? Actually, you don't have to study in detail about it, but I can tell you price effect is the effect of a price change. And two things happen at the same time. Income effect, that is your real income is rising. As a person, your real income has risen. And second one is people substitute the cheaper good in the place of costlier good. One, you buy more because your real income has increased. Okay, real income is, come on, what your money income can buy. So when the price falls, you can buy more of the good with your money remaining the same. Okay, so demand goes up. Okay, then second is substitution effect. That is, suppose you are using a costlier commodity now. I find that product is cheap, and then what will I do? I will use that cheap product in the place of the costlier good that I am consuming. And so, what these two effects together, what happens when price falls? Because of my purchase is more, and because plus my substitution is more, what happens is the total demand will rise. Good question. Advertisement elasticity, no exception. Almost everything. Yes, if you ask me, advertisement elasticity, there are some people who need not advertise. For example, Indian Railway need not advertise, isn't it? So even if they advertise, more or less it will be their the demand will be the same because they are the monopolist. Only person who is running the railway, everybody knows about them. And even if they don't advertise, if I am coming to Delhi, which is your place, Okay, no, not mentioned your place. Okay, if I am coming to your place, I will be traveling by train. Okay, that is advertisement elasticity. Yeah, ma'am will be able to score marks by following the study material only. Definitely, but you have to follow each and every word in the study material. Understand, don't by heart. You have to understand. If you don't understand, you check again and again. You refer internet, read a little more, and understand what is given in the study material. Okay. Cross elasticity for unrelated good, 0. Okay, that is next. Okay, why no PowerPoint? Yeah, because we feel the class is more effective. ICAI feels that the class is more effective when taught like this, because some students are not used to PowerPoints. They want a classroom atmosphere, and I am also happy with the classroom atmosphere because we are so much used to classrooms, okay? And that is the reason. Law of diminishing marginal utility will be surely taught. That is the next question. Yes, next question is, ma'am, supply and price have positive relationship. Definitely, price and supply are, because our price goes up, supply also goes up. Is arc elasticity formula different from point elasticity? Yes, point elasticity uses derivative. Why I am not teaching you this is you are not taught this differentiation in the maths class. So if I talk differentiation now, some students will be slightly upset. That is fine. Okay, but you'll automatically learn it when you are doing your maths. That is that part of your maths. Okay. Given good, I have already explained. Cross elasticity of demand for complementary good is definitely negative, because when one is going up, price is going up, the quantity demanded for the other will fall. They move in opposite direction. Can you teach in binomial language? Binomial language is 2 languages, isn't it? There are so many languages in India. I'm not good at Hindi. But we are given instruction to teach in English because you need English and your English has to improve. Okay, so that's why in the beginning you will find it slightly difficult, but later you will easily find it. And it's always good to learn in English because you've got to write your exam in English, and when you become great people, as started accountants, you will have to interact with people who talk English. Okay, and I think it's good that you learn in English. Okay, then in economics, very easy to study, ma'am. Will you get good marks? Yes, economics is a beautiful subject. My students usually get 45 above for economics out of 50. Okay, so it is very good to learn it. And if you are weak in another subject, economics is a compensating paper, I'll tell you. Then which of the following statement of demand is correct? Okay, that I cannot follow it because it's huge, right? Given good, I already explained today. It's elasticity is, price elasticity is because of the change in own price of that commodity. For example, how your demand respond when there is a change in the price of ice cream, because you're consuming ice cream. That is price elasticity. How your demand for ice cream changes because there is a change in the price of chocolate or dark chocolate or dark chocolate or pastry. Okay, pastry, right? Cakes. That is cross elasticity. I hope you got it. How your demand for ice cream changes because of change in ice cream demand ice cream price is price elasticity. And how your demand for ice cream changes because of change in price in bar chocolate, in pastry, in cake, etc., fruit juice, etc., is cross elastic. I hope it is clear. Inferior good and given good are not the same. Inferior good is only one definition. As your income rises, you buy less of it. But given good is an inferior good on which substantial portion of poor people's income is spent, and when its price rises, law of demand is falsified, does not hold good. When the price of a given good rises, people will buy more of given good. Okay. Right, then, ma'am, negative sign with coefficient price elasticity of demand. Negative sign means inverse relationship between price and quantity. So it always comes like that, okay? If quantity demanded rises, definitely price should fall, isn't it? If the denominator is plus, the numerator will be minus. If the numerator, what you write up is minus, what you write down will be plus. Naturally, you will get a negative sign because of the inverse relationship. Okay, repeat the extra that you would say determinants of supply. Determinants of supply we already explained, you know, that is so many points, that is weather, all those points that we have explained. I hope it is clear. Then meaning and scope of use of supply. My God, this is a basic lesson. Meaning and scope and use of supply. This is a basic lesson in economics. And all, say for example, I'll tell you an example. When you come to intermediate, there is a chapter money supply. There is a chapter money demand. Everywhere there is a chapter on exchange rate. Everywhere we use this demand and supply. Now you are learning the concept. When you go to higher classes, you know, you are going to study quite a lot applying this theory of supply. Then MCQ given in the book, can't say, I don't know, exam questions. Anyway, you learn all the MCQs given, okay. For factors of production, you are coming to that in the chapter on production. Then how to get question papers and answer them. I don't think you get question papers because these question papers are not published by. Anyway, you can you can check the internet. You will get so many universities in different countries giving you utility and indifference curve. We are only coming to that in the next class. How to increase supply of a product, okay. If it is agricultural product, you know, cultivate more. If it is industrial product, produce more. Okay. Can we start supply curve from zero? Yes, good question. Who is that? Yes, very good question. This is from Chandigarh. Kajal from Chandigarh is asking. Of course, we can start the supply curve at zero. It only means that if price is zero, you will supply nothing. Okay. Two firms have linear supply curve or sloped supply curve. It depends, good question. It depends on how this producer responds to the price change. If the producer is responding proportionately for a one change in price, he always responds proportionately. His supply curve will be straight line. But that is unusual. Like proportion, that is price increases 10%, quantity supplied also increases proportionately, some proportion, maybe 20% each time. But that is unusual. Usually supply curves are not linear. Then, but whenever price remains the same, but supply increases, then supply curve shifts to the right. Supply curve, please note, very good that you asked. I'll tell you, supply curve can be linear and non-linear. Linear means the supply curve is a straight line. It happens when there is a constant proportion between price and change in price and change in quantity supplied. You don't have to much worry about it because some people, for convenience sake, they draw a straight line. Sometimes we draw a non-linear curve. You don't have to worry about it. Just understand, you get a linear curve when there is a constant proportion between change in price and change in quantity supplied. Okay. Can't advertisement elasticity be negative? Definitely not. You know why? All advertisement will bring some amount of positive sales. If advertisement elasticity is negative, that shows your advertisement has done harm to your product. People have stopped by reduced the product buying of your product. It can be so because sometimes some advertisements are very bad, like obnoxious. They are not very positive sometimes. But usually, when you design advertisement, you will be very careful to design in such a way that you increase the sales and it is positive, because your objective of advertising is to increase your sales. Okay. So generally, advertisement elasticity, but theoretically, it will not be negative. Okay. Ma'am, supply curve can originate from, yes, supply curve can originate from 0. Is there any exception to the law of supply? Usually because producers supply only at higher price. Okay. But there are straight line supply curves parallel to the x-axis. That is, more will be supplied even at the same price. Okay. That is our supply curve, which is a perfectly elastic supply itself, is an exception. That is you are supplying more even at the same price. Then it is an exception. Okay. What about unit 2? It will be taught. Don't worry. Why movements are increase and decrease in quantity supplied? Yes. Please note who is this person? Yes. Anit Gautam. Okay. Movements and increase and decrease quantity supply. Please note movements along the demand curve or the supply curve to increase in quantity or decrease in quantity. Because when you move along the supply curve, it is due to changes in price. I hope it is clear. Whenever a change in price causes a change in quantity, it is movement along the demand curve or along the supply curve. Okay. But increase in demand or increase in supply, decrease in demand or decrease in supply happens not because of price change, but because of changes in factors other than price. I hope it is clear. Increase or decrease, either it is in demand or in supply, takes place because of factors other than. It is not because of price, it's because of all the other factors. Okay. Demand and quantity demanded, you can use it interchangeably. The quantity is increased without changing the price, maybe yes or no. Yes, it is possible. Quantity may change without changing in price. For example, if production is more, in agriculture, wheat yield is more, cotton yield is more, we call it an increase in demand or increase in supply. Okay. Increase in demand is more is demanded at the same price. Increase in supply is more is supplied at the same price. I'll tell you, there is a bumper crop, weather is very good rains in your place, and wheat growth is very good. Price is the same, but more will be supplied, isn't it? Then, ma'am, can you explain paper pattern? Paper pattern, I think it is question pattern. It is only multiple choice questions. Don't worry at all. You don't have to draw any diagram. You don't have to write anything. It is multiple choice. But don't think multiple choice is easier than writing. You need to really be clear about the concept. Learn well. We'll be teaching you well. You can learn on your own. You don't have to depend on anybody else. Please share your screen, madam. PowerPoints I have already forwarded to the institute. You can ask, they will give you. Theory of consumer behavior, ma'am, you didn't tell. Definitely I will tell. As demand falls with an increase in price. Demand falls with an increase in price because, yes, good question. I will tell you, as a person who buy, I like to buy at the lowest price. As a person who sells, like to sell at the highest price. So I buy less only at less at high price, and the opposite. Okay. Then there is one more question. That is a calculation. I think these people have to close this place, and so I can't get it. Yes. 1 second. When price is 40, quantity demanded is 15. When price is 38, I'm not able to read it because that Excel column is not, I'm not able to read it because time is superseding it. Okay, you can send the question tomorrow. That is, who is that from Hyderabad? Tarun Kopala, please, sorry, I can't read completely your answer. I'm so happy. I was with very extremely good students who are very attentive. Thank you so much, and see you in the next class. And when I see you in the next class, everything should be done, learned properly. And thank you for your patient attention, and thank you so much. Stay safe and stay happy, stay vibrant, and do your lessons well, and all good wishes. Thank you.